Welcome back. Thanks again for watching another video. So tax season just ended April 15, 2024 last week, and we saw a lot of individuals make Roth IRA contributions as well as traditional IRA contributions, which is great. They're building out their retirement account. In this video, I'm just going to walk through the difference between a Roth IRA and a traditional IRA, because I think there's some confusion in terms of the tax benefits, what your income is, what you can contribute to versus not contribute to, as well as one mistake that we constantly see every year. There's always some person making this mistake, and their financial advisors should alert them when that mistake happens. And this is another reason why you want to have a financial advisor, especially doing the backdoor Roth, is they manage it for you. You don't want to be making these contributions yourself. Just have your financial advisor do it for you. And at the end of the video, I'm going to show you a tax return and to show you where these contributions show up and to show you what the tax benefits are or aren't based on what you contribute to. If you have any questions, leave them in the comments below. Thanks again for watching.
All right, so I'm going to walk through a couple slides here on the difference between the Roth and the traditional IRA, and then after this, I'm going to show you a tax return to kind of show you the impact of making these contributions. So I got two slides for each one of these retirement plans. So let's start out with the Roth IRA. So here are the facts. So it's an individual retirement account. Contributions are made with after-tax dollars. So what does that mean? These are dollars that have already been taxed, right? So think of, you get paid from your employer, you put that in your savings account, right? Or your checking account. That money has already been taxed, okay? Because your employer is kind of taking taxes out of that. You've already paid that tax to the IRS. So this is after-tax dollars. There's no current tax benefits of a Roth IRA, meaning that, and you'll see this in the traditional, if you make a contribution to your Roth IRA in 2024, there's no tax deduction that you're going to get on your personal tax return, okay? The next thing is contributions and earnings grow tax-free, okay? So you put $5,000 into your Roth account, that gets invested, and that $5,000 becomes $6,000, right, at the end of year one. That $1,000 increment, you don't pay tax on, okay? Now, the withdrawal age is 59 and a half. You don't want to take your money out of that Roth IRA before the 59 and a half. There are some examples where you can, but it's very rare. So just say you're 60 years old, you take that $6,000 out of your Roth account, you don't pay any tax on it, okay? And that's the big benefit of the Roth IRA. The thing is you need, in order to contribute to a Roth IRA, you need to have earned income. Earned income, think of, you got a W-2 wage, right? You've earned that. You have, you own a partnership or an S corporation, right? You own a business and you're getting paid from that business. That's earned income. But if you have like dividend income, you have interest income, that's not earned income. So you can't contribute to a Roth IRA in that case. And that's where if you have a business and you hire your children, right? And this is all, legitimate hiring. They're doing duties for your business. One of the advantages of that is, people are kind of talking about the W-2. You don't have to pay, federal income tax, all that other stuff. The bigger benefit here that we're seeing a lot of people miss when they hire their children is now their children have earned income, right? They have a wage because they're working for the parent's business. Now you can set up a Roth account for your children and contribute money to their Roth account. There's no mandatory withdrawals. So this is key. So once you hit, and I think this might be on the next slide here. It is on the traditional IRA, is once you hit the age of 73, you have to start taking these required minimum distributions, or RMDs. And you have to take these out of your retirement accounts. When you have your money in a Roth IRA, you don't have to take money out of your Roth. You can take money out of your Roth once you're past the age of 59 and a half. You can take that money out whenever you want to. So that's another plus of a Roth IRA. Continuing with the facts here, inherited Roth IRAs. So if, a family member passes and you inherit their Roth, the withdrawals of contributions into that Roth IRA are tax-free. So just say one of your parents, you inherit one of their Roth IRAs. Every year they were contributing to say $5,000 a year into that Roth IRA. Those contributions that your parent put into that Roth IRA, into their Roth IRA, those are tax-free when you take them out. Okay. And then earnings within a Roth IRA, an inherited Roth IRA, are typically tax-free, but some of them are subject to tax, right? So if you're taking this out before the age of 59 and a half, that could be subject to tax. The big thing here is your adjusted gross income and who can contribute to a Roth IRA. And you got to look at your modified adjusted gross income. And this is going to be in the example of this tax return I'm going to show you so you know where to look. If you're filing a single return, your adjusted gross income has to be $146,000 or less. If you're married, your adjusted gross income has to be under $230,000. And this is 2004 numbers, right? So every year these numbers kind of increase. So I'm making this video here in 2024, and these are the amounts. What we see people get stuck in is they don't see this, right? And they just like, oh, I want to contribute to a Roth IRA. I've earned income. I want to contribute to it, right? I think it's more beneficial than a traditional IRA, but they're filing a joint return and their adjusted gross income is $250,000. You can't contribute directly to a Roth IRA if your adjusted gross income is in excess of this amount. That's why you have to watch what this is, what these amounts are, and where you fall in the tax bracket. And that's where when you make these contributions, you want to do it in line with your tax return, right? Because you're not going to know what this number is. So this is a mistake that we see a lot of people do. So when that happens, then what they have to do is they have to take money out of their Roth, whatever they put in, they have to take it out. Then they have to contribute to a traditional IRA because they don't meet the criteria here. Now, there's one thing that you should, again, we advise you to have a financial advisor, right? You should have one doing this for you. But what if your adjusted gross income is $250,000 or $300,000 or $500,000 and you still want to contribute to Roth? You can, and the process is called a backdoor Roth conversion, where you contribute to a traditional IRA and then immediately those funds are withdrawn and put into a Roth IRA. So you're still contributing to a Roth, but there's a couple steps that are involved. And again, you don't want to do this by yourself. You want to have your financial advisor do it. Okay. And if you're working with a good financial advisor, and this is going to go to the last slide that I'm going to talk about here, is they're going to know all of this, right? So they're going to stop you if you make more contributions than what you should. So for 2024 tax year, if you're under the age of 50, the most you can contribute is $7,000. And if you're over the age of 50, you can contribute up to $8,000, okay, to your Roth IRA. This is another mistake that we've seen people do is they don't know the minimum or the maximum contribution and they're just putting in $9,000, $10,000. Well, you can't do that. So then what happens is they have to take that money out immediately. Okay. So that's more steps that are involved here. So that's the Roth IRA. Now let's talk about the traditional IRA. So the traditional IRA, again, another individual retirement account. You contribute pre-tax dollars or you contribute after-tax dollars. So we talked about after-tax dollars, and pre-tax dollars are money that maybe your employer has set up and you can contribute that way where the money hasn't been taxed yet. Okay. There are potential current tax return benefits, meaning that when you contribute, just so you contribute, $5,000 to your traditional IRA account, that money could be treated as a deduction on your tax return. Okay. So there is a tax benefit where, unlike the Roth, you contribute in a year, you don't get any deductions on your tax return. So that's another misconception or a mishap that we see a lot of individuals miss there. The earnings grow tax deferred. Okay, so what does that mean? So you put in $5,000, you earn $1,000 additional. That's tax deferred, meaning that when you take that money out, that $1,000, you got to pay taxes on it. Okay, and it's ordinary income tax on your withdrawals. Okay, so it's unlike a Roth where it grows, tax free. This is eventually you're going to have to pay taxes on that money. So think of, you invest in the stock market, you have an account with Schwab, and you invested in Apple, you put $1,000 in over time. Now that $1,000 is $10,000. When you take that out, that's actually capital gains. This is kind of like the same concept where it's going to grow, but once you take that money out, you're going to have to pay tax on it. And then unlike the Roth, once you hit the age of 73, you have to start taking money out of your IRA account, whether you want to or not. And then there's no income limitations on opening a traditional IRA. And then the annual contribution limits. And by the way, what this means is, remember when we talked about the AGI here for Roth, there is no limitations there. So you can make as much as you want. You can still contribute to a Roth IRA or traditional IRA. And then in terms of contribution, limits or max that you can do each year, this is 2024. Here are the amounts. And then penalties, again, if you distribute before the age of 59 and a half. So then, you kind of look at, this is the last slide here for the traditional IRA. You look at both of these slides, right? You look at the Roth, you look at the traditional, you're kind of thinking like, why would I even want to do the traditional? Yeah, I might get a tax benefit on my tax return, but long term, the Roth is the way to go. And short answer is yes. At the end of the day, you kind of want to have as much as you can in your Roth accounts by the time you retire. And this could be, conversions and a lot of other things. But one thing to consider is, what do you think your tax bracket will be when you retire? If you think it's going to be in a lower tax bracket than where you are right now, you may want to do the traditional IRA right now, because you're going to get a tax benefit on your return now when you're at a higher rate. When you retire, if you're in a lower tax rate, you're going to be paying lower taxes on the money that you're taking out. So that's one thing to kind of consider. And if you're working with your CPA, they can kind of do an analysis. I know that we do this with our clients when they're thinking about traditional or Roth. We can kind of plan all this out. And then I'm going to leave you with like 2 reminders, which I've already talked about. You can't contribute more than the annual limits. Very important. We've seen this. It happens at least once a year with our clients where they're putting more money into their account than they should be. And then they have to take out that money. And then you got to work with a financial advisor, especially with this backdoor. You don't want to be doing it yourself. So that's it on the slides. Now I'm going to go through a quick tax return, and that should end everything. Thanks. All right. So really quickly here, the last part of this video, here's a tax return. You got an individual or a couple here filing married, filed joint. They have 2 kids, and their adjusted gross income here is $114,000. Now, they can contribute directly to a Roth, okay? Now, we're assuming that both of them have earned income. They can both contribute directly to a Roth. Those contributions will not show up on their tax return, right, as a deduction, okay? So they're going to do that directly, okay? The other option for them is they can do a traditional IRA, right? So let's say, so right now, let's go back to page 1 here. And we're going down to page 2. And right now we're showing a refund for them of about $11,212. Okay. Now just say they want to contribute to a traditional IRA, right? Not a Roth IRA, traditional. And remember in the slides, when you contribute to a traditional IRA, that those contributions could be a deduction on your personal return. So we're going to they put in $6,000. Okay. So So we're going to recalculate this, and we're going to see what that refund amount is. So let's go back to page 1 or page 2. So the refund increased. Okay, so now the refund is $11,986. And where we're going to see this adjustment is on Schedule 1. We're going to go down to line 20. And again, this is the 2023 tax forms. Okay, so every year the tax forms change, line items and all that. So 2024 is probably going to change. So this line item, depending on when you're seeing this video, could change. But you can see here adjustments to income. So here are all the different types of adjustments to help reduce your income. And one of them is the IRA deduction. Here it is. So we're going to go back to the 1040 here. We're going to go down to adjustments from income right here. So they started their adjusted gross income. Well, their total income is 114. They had some adjustments to kind of further reduce it to get their adjusted gross income. Now it's 108. So in that is the traditional IRA. So again, they contributed $6,000 to their traditional IRA. That doesn't mean that their refund increases by $6,000, right? Their refund increased, maybe it was like $800 or so. Okay. So, and I talked about this before in other videos. Just because you're contributing to something doesn't mean your refund is going to increase by that amount. Okay. Because it's a big tax formula here. But it's better that you're building up your retirement account than having to pay that extra $800 to the IRS, or your refund's going to increase anyways. That's how this scenario is set up. But anyways, that's what this is here. Now, when you do the backdoor Roth, right? When you do the backdoor Roth, what happens is you're going to get a tax form in the mail. Because as part of the whole backdoor Roth is you're contributing to a traditional IRA, then immediately those funds are taken out of the traditional IRA and put into a Roth IRA. So whenever you take money out of like an IRA account, you're going to get a tax form called a 1099-R. And that 1099-R tells the IRS, hey, this individual took money out of the IRA. Now it's up to your CPA to put that reflective correctly on your personal return. Because if it's not reflected correctly, you could have to pay tax on that, right? Because it's a distribution from your IRA. So when most people do their backdoor Roths, it's going to show IRA distribution, an amount right here, but taxable amount is 0, right? Because the whole backdoor Roth is a non-taxable transaction. But you still got to reflect this distribution, this tax form that you got, right? Because the IRS got it and they're expecting to see it somewhere on your tax return. So again, that's the backdoor Roth. In this case, their AGI is below the threshold that I gave in the presentation. So they can contribute directly to a Roth if they want to. They can also do it to a traditional if they want to. So here's kind of the flow on what this looks like on a tax return. Now that for the Roth, that line item you want to look at is this adjusted gross income, right? So if you're below that threshold, you can contribute directly to a Roth. If you're above that threshold and you want to contribute to a Roth, you can do the backdoor approach. Okay. So hopefully this helps answer any questions. If you have any additional ones, leave them in the comments below. Thanks.